Today's podcast is brought to you by Jerry Robinson's Market Barometer, a powerful tool for investors who want to avoid the next major market downturn. Learn more at marketbarometer.org.
Good morning, friends. Welcome to Follow the Money Daily, a new daily podcast dedicated to your personal, spiritual, and financial freedom. Hosted by myself, Jerry Robinson. I'm an economist, a best-selling author of the book Bankruptcy of Our Nation. We run the website ftmdaily.com. Very simple, followthemoneydaily.com. And I'm joined by my lovely co-host, Jennifer Robinson. She's the national director for our very own Christian Financial Advisor Network. Hey, Jennifer.
Hi, Jerry. And you can find Jerry's book, by the way, the book Bankruptcy of Our Nation, right there on our website, ftmdaily.com. You can also get the book in audiobook. It's been very popular on audiobook as, of course, so many people are in their cars for a couple of hours every day working out at the gym. You can get Jerry's book, Bankruptcy of Our Nation, on audiobook now.
Yeah, that's been really popular. You know, we're going to be talking today, by the way, about the explosion in world stocks all across the board, no matter where you look, whether you look here in the United States, if you look in Europe, if you look in Asia, Middle East, it really doesn't matter. You're going to find that stock markets are just rising around the globe. So we are in this massive bull run. That's a global bull run. And I want to talk about that in just a moment. Plus, we're going to talk about the three most common mistakes that most people make today when investing. We're going to share some good ideas with you, I think, in this brief podcast. But first, I was on my way into the studio this morning, and I saw another headline related to the minimum wage. I saw that Vermont's governor, I believe, just signed into law an upgraded minimum wage. Of course, we just heard about Seattle passing a $15 per hour minimum wage. And I just want to weigh in for a moment on this because, you know, minimum wage, I think the typical or the standard response is, well, you know, we don't want to give more money to these people because, you know, they're not worth it or whatever the case. You know, that's the typical Republican response. You know, we don't need to pay more because the free market can't bear it. Well, I'm totally in agreement with that, but I have another argument to add to it, and that is that if you begin to pay $15 an hour for people to flip burgers in Seattle, then you have to realize that, you know, other people who are much more, they're much more capable of flipping a burger, okay? Maybe even have a college degree, who would love to have $15 an hour in this current economy. They're going to come knocking on the door. So just by increasing the pay for people who are in these minimum wage jobs, it's not how you solve it, because all that does is it attracts people from other industries or people who are out of work who want $15 an hour, and they're going to come down, and all of a sudden you create a massive competition for these low-paying jobs. And so the person who, you know, they were trying to help in the first place, the person who's a low-wage earner, now you just crowded him out because you just started paying more money for this job, and now you have all this new competition that didn't exist at $7 an hour. So it's almost as if these, you know, of course the politicians don't understand economics, but if you pay more money, you're going to attract a higher quality person and with more skill set, higher education. And when you do that, you crowd out the guy you're trying to help. So this whole minimum wage thing is just silly. You know, whenever I was out in Santa Fe, you know, they have what they call a living wage, and there are living wages around the country. And they just don't work out that well. I mean, that's just what you see when you look around.
Yeah, we're in a state that has one of the lowest minimum wages here in Arkansas. And remember, just a couple of weeks ago, we were trying to get some grounds and maintenance work done here at the offices. And we were offering $10 an hour, whereas the minimum wage here is it's between $6 and $7, maybe $7.25. So we were offering more than the minimum wage, and we couldn't get anybody to get in here for $10 an hour. Yeah, it was really bizarre.
Yeah, nobody wants to work for that. So This whole minimum wage argument is a little bit silly. Certainly want to see people paid what they're worth, but again, you start messing with these price levels or these pay levels, and you're going to get different people applying. And the manager sitting behind the desk, he wants the highest education, he wants the best bang for the buck, just like everybody else. He's a rational economic actor, so he wants the best thing that he can get for $15 an hour. And if it's between somebody who has a high school degree, who was working for 7 and now wants 15, and a guy who has a college degree who can't get a job because he got a college degree in fine art, and he wants to flip burgers, guess who the guy's going to pay? He's going to pay the guy with more college education. I mean, that's just how it goes.
Right. He might come in and flip burgers, but also offer maybe an updated system to the inventory line. Maybe he learned something in college that he would offer
just more value.
A little more value. And so, this argument is, it's going to crowd out those who would work for $7.50, $8 an hour.
It will, and it's a silly argument. Okay, now let's talk about the stock markets, because all around the world, as I mentioned, the world stock markets are soaring. MSCI's All-Country World Share Index of stock performance in 45 countries was up just over 0.12% to 427 as of yesterday. And that, I tell you what, if you don't know what that means, don't worry. The MSCI World Index at 427, all you need to know is that just right before the peak of the big stock market bubble that we had back in 2007, right before the peak, the world stock market index got to 428. So we are within striking distance of where we were just before the crash back in 2008. So that's very telling. We're back to a strong, what I would say is a resistance point, but we have plenty of upside potential to go from here, even though these markets seem to be very overbought. And much of what we're watching has to do with the central bank's intervention. We've already talked about how the ECB is pumping in money. We've also talked about how the Fed continues to pump in money and how Japan continues to do that and how China continues to do that. So we're continuing to see this, but you may not have heard about this, but since the start of 2013, the stock market in Dubai has registered a near 200% gain to become the best performing financial market in the world. That is just over the past, 16 months or so. Dubai has returned a 200% gain to investors. And a lot of it has to do with the fact that this, the country, the UAE, has moved from being what they call a frontier market to an emerging market. And that shift certainly has helped that country. We also have places like Qatar, who are also now called emerging markets. So basically, Dubai and Qatar, these areas are now considered the same investment status like China and Brazil. So many people are ignoring the Middle East, but I tell you what, we've been tracking the Middle East with our global ETF cheat sheet that we have on our website. And every single month there, we update all of those stock markets. And one of the things that we have seen consistently is that the Middle East has just been rising dramatically. So we think of China, we think of India, we think of all those things. But really, the Middle East has also been one of the biggest players, with Dubai being the number one player for the last 16 months. It
has, and we do actually rate 39 different nations' stock markets in that ETF report that we do for our FTM Insiders every month. And only 6 of those nations are not in a bull market, an uptrend. So 33 out of the 39 markets that we track in the global markets are totally green. They're in a massive uptrend.
Well, now let's talk about the U.S. stock market, because the U.S. stock market is probably the one that's most concerning to you. Is it due for a correction? Are we getting ready to see a correction? Because we're certainly at very, very strong highs right now. Well, consider this. Since 1896, the Dow has suffered a 10% correction about every year. But this current rally that we're in now, the Dow has not had a 10% pullback in now 32 months. indicating that we are very overbought at where we are. We're just due for a pullback. I mean, when you really think about where we are, we're really due for a crash. But I don't think that's going to happen because we have far too much monetary stimulus support, and we have too much goodwill from the Fed and from others that want to see this market continue higher. So we have plenty of support on the downside to prevent that from happening. But just since the beginning of January, investors are beginning to realize that if they're not in the stock market, they're really being left out cold. Since the beginning of the year, we've had $1.6 trillion in new wealth generated just from the share price increases across the board in the United States stock market. But what's been really concerning is the volume. Yesterday, for example, in the markets, we saw 5.4 billion shares in the United States markets change hands. That's below the average 5.75 billion that we would normally see on a Monday. So, even though this market is grinding to new highs, it's not coming on higher volume. And as a long-time trader, a long-time investor, I can tell you that's not a good sign. There should be more broad participation in this market to see it at this current level. And the fact that we don't see a lot of broad participation by investors indicates that this is probably just going to be a thin rally. And hopefully we'll see some volume kick in. And much of the volume that needs to come into these markets, I think from Wall Street's perspective, are the people who are sitting on their hands on the sidelines. There are still mom and pop investors out there who got burned in 2008, pulled all their money out of the market in 2009 at the very bottom, and have stayed out. And now, with everything that's happening, they're suddenly talking about moving back in. Wall Street wants all the mom and pops to begin put their money back in. Please don't do that. If you haven't been in this market up until now, don't deploy all your capital at these levels. If you want to get into this market, tiptoe in, slowly move in, baby steps into this thing, dollar cost average, and don't dump all your money into this current rally because it is not healthy. This current rally is not healthy. Even though they're going to tell you that, oh, look, it just keeps going up and it's just going to keep going up. Well, that's what they always say. So just be very, very careful if you're on the sidelines and you're looking at this market and thinking about getting in. Let me tell you the best way to do it. My advice from one investor to another would be to learn to be able to exploit some of these movements. So learn how to swing trade or learn how to exploit some of these existing trends instead of just buying and holding and hoping, which, by the way, is one of our common mistakes that investors make. We'll talk about that in just a moment. But overall, the S&P 500 is trading at about the same level on a multiple basis. If you take a look at the overall profit projections, we're trading at about the same place as we were back in 2007. And right now, there are increasingly bearish bets against the S&P with probably about a threefold increase overall in the amount of shorts against the S&P 500 ETF, indicating that there is some continued bearish movement out there. People want to see these markets go down, but every time they short a stock, they get crushed. And so many people have kind of stepped out of that game as of late. But let's talk about these three costly mistakes because I want to keep this podcast short and I want to just bring this to your attention. There's three really common mistakes that we see a lot here at FTM Daily that investors make. And the very first one we already mentioned, having a buy and hold mentality. The concept of, I'm just going to put my money in the market and, it'll be okay because it always goes up, right? It always goes back up. Well, let me tell you the reason why that is a very bad way to think in this current market, because think about how we got to where we got to. Remember where we were in 2009, about the very bottom of the market in March of 2009? And then slowly the Fed had to begin pulling us out of that with all this QE, and they began to print all this money. Well, we have had an unprecedented intervention into these markets by the Fed. All right? The Fed has pumped in so much money, there's nothing in history to compare it to. Nothing. So when we take a look at that and we think to ourselves, the markets always go up. Well, the markets always go up if you put it on the ER table and you start jolting it with defibrillators. Then, yeah, of course the market's going to go up. But how many times can you do that? And how many times can you continue to do that? So I think where we are now is a very unprecedented time. And if you buy at these current levels and you think that if the market drops, we're just going to come right back here, I have to tell you, I don't know. I really don't know. This is probably one of the things that separates us from many of the other podcasts out there, and the fact that I'm concerned that the levels that we have reached today have come as a result of massive intervention, and therefore these levels are completely artificial. And you cannot sustain these levels without continued intervention, meaning that when we fall back to earth after all this is over, how in the world do we climb back to this level whenever, in order to get to this level, it took the most Herculean intervention in world history, right? You think we're just going to come back here on our own just because the economy's good? Well, see, that's a big risk. So buying and holding in many ways, if you're of that same persuasion, suddenly doesn't make sense either. So it's important, I think, for investors to drop the concept of buy and hold and instead focus upon, I'm going to take my money and I'm going to buy whenever the markets are rising. And whenever the market begins to tank, I'm going to step to the sidelines. I'm going to wait it out. Now, some people say, well, you can't time the market. And if you look at people who've done that throughout history, it's so much better to leave your money in the market. Well, I tell you what, I promise you, I know who came up with those statements. There are people who work on Wall Street, and there are people who benefit from you giving them your money and leaving it there. Listen to me. Banks on Wall Street, banks in all across the country, you know what they want? They want one thing. They want your money, right? It's just truth. They want your money. And they don't just want your money. They want your money for as long of a time period as you will give it to them. And they want you to keep it with them for as long as possible. And they want something else. They want you to take as little of it as possible back. So banks have the wrong incentive. So when they teach you about Wall Street and they teach you about the stock market and they teach you that you're supposed to give us your money and that's how you win, well, you need to wake up and smell the coffee, because you realize it's the fox guarding the hen house there, so to speak. So no. Buying and holding in this environment is not a good idea in my estimation. What we need to be doing is we need to be exploiting the trend. The trend's going up. Market's moving three directions: up, down, and sideways. And that's what our market barometer, which the show today is brought to you by the Market Barometer, and it has three different lights: green, yellow, and red. All of our subscribers, whenever the market is clearly in an uptrend, they receive a real-time email alert that says the market's green. Now is a great time to be entering. Whenever that market turns sideways, as soon as we see that, and we get real-time instant updates every single day, and when that changes, when that trend changes, we alert all of our subscribers with a yellow light. And then as soon as that sideways motion turns into a downtrend, instantly we alert our subscribers. Why would you want to sit in a market that's going down? Right? I mean, right now everybody wants to sit in the market as it's going up, but I want to know who the people are who want to sit in it while it's red. Why not lock in all those profits that you've made over the last several months and then wait for the next bottom to be carved out and then buy it again on the green? That's what Jennifer and I do. We buy on the green, we sell on the red. And, it's worked out well for us, even though Wall Street would try to tell you differently.
That's right, Jerry. Now, number 2 is doing all of your 401k planning in your HR department.
Yeah, this is probably one of the biggest problems that we see, at least consistently, is that a lot of people tend to turn to their HR department at work looking for advice for their 401k. And that kind of makes sense when you think about it. I mean, the HR department is the one who has the plan documents. They certainly know a lot about the 401k plan itself. Many of them are even educated sometimes on investments. And I've met some very smart HR people over the years. However, it's unfortunate that so many people don't seek outside advice for their 401k, because oftentimes that's the biggest pot of money that they have for savings. And they're relying upon someone who's not really an investment advisor of any kind to tell them how to handle it, what to do with it. And so we really encourage people to really seek outside advice for their 401k. Jay Peroni provides a free consultation on your 401k. He's one of our advisors here in our Christian Financial Advisor Network. He's one of the ones I think that might be one of the only ones that really provides a real specific 401k tune-up the way that he does. But regardless, I think it's very important for you to be looking into outside advice for your 401k. Don't put all your money, obviously, in your company stock. People from Enron found out the hard truth about that. And also be very cautious about the mixtures that they show you. There's these target date funds that you'll often see in these 401ks, and the way you'll know them is they'll have like a year. It'll say like Merrill Lynch's 2040 target retirement fund. And basically they say, well, if you're going to be retiring around 2040, then put your money into this. If you're retiring around 2050, then put your money into this one. Well, these have been shown to be extremely high fees. They are a very bad deal for the most part. And in fact, my good friend Barry James Dyke has wrote a book called The Pirates of Manhattan. And I think it was part 2 where he just destroys these target date funds, shows how much of a farce they are, how high fees they have, how they're big money generation schemes by Wall Street, and they're not really designed to help you retire. So, again, do some real due diligence with that 401k, especially if you have a lot of money in it. And don't forget to take advantage of the match on your 401k. So many people don't take advantage of it. But unlike Dave Ramsey and Susie Orman and all the other personal financial gurus out there who are telling you to stuff every single dime into your 401k, we don't agree with that. We think that you should contribute up to the match and no more. If you're eager to put more money in for retirement, open up a Roth IRA or fund another account. But don't overdo your 401k. It should just be one component of your overall retirement plan.
That's so true. Okay, let's get to number 3, and that is making up for lost investment time by trying to hit home runs in the stock market.
This is such a common thing. So many people reach the stage in their life where they realize there's that moment, there's that epiphany where they say, oh no, I'm this far away from retirement and I only have this much money, and they start doing the math and they think, oh no, what am I going to do? And so what do? Well, they start trying to compensate for lost time. And the way they do that is they will begin to take on excessive amounts of risk in this effort to generate more money for their retirement plan so they have more to live on. And that's an understandable approach, because if you don't have enough money, you got to do something to make the money. But unfortunately, instead of just being a very consistent saver and a consistent investor over time, they wait and delay until the last minute, and then they have to go out and they have to hit these home run stocks, or they have to hit home runs in the stock market, or they have to take this risky bet on real estate, or they have to, put all their money into this, up and coming franchise, which may or may not work. And so none of those things are bad in and of themselves, but whenever you're doing those things because you did not plan properly, well, that's not a good thing.
Your emotions get in the way too much in those investment decisions.
That's why we teach our 5 levels of financial freedom here. You don't hear it in school. You don't learn it in certainly on TV. The financial education in this country is so low. So we created our 5 levels of financial freedom. If you're listening to this and you want to learn kind of how to break free financially, we have a free tutorial on our website. It's ftmdaily.com/5 levels. And there we explain the absolute importance of developing a savings plan, then how to diversify that savings, and then how to begin approaching investing and how to diversify your investing. And then we talk about income, and we talk about the importance of not just creating income, but also diversifying your income. That's why we talk about the 22 different income streams that you can create both now and in retirement. We teach those in our Income University for all of our subscribers. So, a lot of good information there on our website.
Yeah, and Jerry, one other thing I wanted to add, for those who are at that point in their life where they are wanting to retire, but they don't have enough money saved and they didn't invest consistently throughout their working years. Well, it's really not good enough for them to say, well, you should have been more consistent. You should have said, that's not a very good solution for them at this point in their lives. And so I would say to that person who might be listening, one really good solution is to, instead of thinking about making it big in your investments, start thinking about 2 or 3 or 4 different income stream ideas that you can begin creating right now. And then, invest in the markets, but do it more on a less risky basis.
Yeah, and I would say probably a third of those income streams out of the 21 or 22 income streams, probably a third of them require mainly time. The other 2/3 require some money. There's no doubt about it. But some of these income streams, you say, I don't have any money, I can't create income. That's not true. As long as you have time. You can either trade time for money or you can trade money for money. And we teach you how to do both. So you can go to our website and learn more about that. It looks like we're almost out of time. Jennifer, tell me where the markets are right now.
Okay, well, the S&P 500 is right about 1948.
You know what? Yesterday we did cross above the 1950 level. We got all the way up to 1954, 1955 on the S&P 500. You know, we've been watching that 1950 level. And so we crossed above it and closed above it yesterday. Very bullish. Today we're having just slightly, sounds like it's just below the 1950 level.
It's just below. It's dancing around. It's actually coming back up towards that 1950 level now. It's headed up, but it's still lower than it was yesterday.
So the bulls and the bears are just kind of playing the tug of war around that area. What else? What's happening in gold?
Yeah. Gold is at 1260 right now, a little higher than yesterday. Silver is 1917, so it's slowly making its way up in the last couple of days.
Okay, so gold, there's been not a whole lot of good news coming from the hedge funds and mutual funds. They're really continuing to be fairly negative on gold. However, the latest data I've seen on silver shows that many of the money managers are going out and beginning to take long positions in silver, betting that it's going to go higher. We're seeing a strong demand for silver also going across the investment world. So silver is starting to perk up a little bit, and that's exciting because silver's at $19, and you know that it should be much, much, much higher than that in the long run. So a very good opportunity on silver right now, I think.
Yeah, and those of you who are a part of our Trigger Trade Report, our FTM Insiders, we actually sold 5 of our positions yesterday. And even if you're not part of our Trigger Trade Report and you don't follow that, check out our homepage, ftmdaily.com, and you can see all 5 of those trades that we actually sold yesterday and see how we did. They were all in the green, and it was a really great day yesterday for Trigger Trade.
Yeah, we got all of our Trigger Trade folks into Italy and into Spain right before the announcement on ECB, and then they both popped up nicely, so we enjoyed those gains. And we're a real conservative outfit. You know, we're not out there, like we said, we're not out there trying to hit home runs with every single trade that we do. We just want to make anywhere between 1% and 5% over a period of, anywhere between 1 and 5 weeks. I mean, that's 1 day to 5 weeks. So, it's a very conservative system, and you can learn more about our trading philosophy on our website, or actually go to the brand new website for the trading software. It's triggertradepro.com, and you can check out all that there. All right, friends. Well, that brings us to the end of our program. Again, I really thank you so much for tuning in today. Remember, if you have any questions or comments for us, you can always reach us by email, info@ftmdaily.com, or you can always call us, 800-609-5530. As always, I leave you with this final word, this time found in the book of Proverbs, chapter 3, verses 5 and 6. One of my favorite verses. It says, "Trust in the Lord with all of your heart. Do not lean upon your own understanding. In all your ways acknowledge Him, and He will make your paths straight." Sound advice from a trusted source. Remember, friends, when you want the truth, just follow the money. Until tomorrow, God bless.
All of the information contained on Follow the Money is strictly for informational and educational purposes. The views and opinions of our guests and sponsors, including Tom Cloud and Jay Peroni, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry and Jennifer Robinson do hold their insurance licenses and may offer consulting on life insurance and fixed retirement income products. Jennifer Robinson is an investment advisor representative with Faith-Based Investor LLC. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.